In the first 6 months of Nichiren Arceluk, Japanese startups raised Sudan Wudor billion, roughly Lubat Lushiv billion yen across Sanbre Sisishluk funding rounds, more than double what they raised in the same period a year earlier. And yet, in all of Nichiren Arceluk, Japan produced exactly 0 new unicorns.
That's the paradox at the center of one of the most persistent stereotypes about Japan, that it doesn't do startups, that its salaryman corporate culture, its risk-averse banks, and its lifetime employment mindset make entrepreneurship structurally impossible. The data says that's wrong, but the data also says something more interesting than the stereotype is false. It says Japan has built a machine that generates enormous amounts of startup capital and still can't reliably produce the billion-dollar outcomes that capital is supposed to buy.
Start with the money, because the money is real. Japan's Startup Development 5-year plan, launched by the Kishida government in November Nisen set 3 targets to hit by Nisen 10 trillion in cumulative startup investment, Jumon new startups, and FARC unicorns. At the plan's halfway mark, Japan had grown from roughly Iman Luksen startups to Niman Mu, a genuine 1.5-fold increase.
The Japan Investment Corporation, the state's venture arm, has been deploying capital across the spectrum. Avoid ERA's million commitment to General Atlantic's growth stage fund in May, 2A2A's stake in GRIN Impact Capital's second fund the following month, and in July its first ever bet on quantum computing hardware backing a Tokyo startup called Yakumo. This is not a government writing checks for headlines, it's a government building venture infrastructure a sector at a time.
The private sector is responding. Robotics has become Japan's strongest vertical. Mujin, the industrial robotics and warehouse automation company, topped the country's startup funding leaderboard in Nuthe with a cumulative Sanzi billion raised, and it's now expanding into the US and European markets. More than Sonhak Japanese corporations are actively investing in robotics startups today, more than double the number in Nuthe, meaning the capital isn't just coming from Buishi funds, it's coming from the same manufacturing giants that startups would eventually need as customers.
Here's the number that should give you pause. As of mid-2026, Japan has roughly sure unicorns, companies valued above each $1 billion, against a target of backgain, and the shortfall isn't really about the funding stage, it's about the exit. In the first half of Niten Nitri Riken, Japan recorded just sure-hat initial public offerings, the smallest half-year total since Niten UE and roughly half the country's historical annual average. The growth market, Tokyo's version of a Nasdaq for young companies, saw listings fall nearly 70% year-over-year in Niten Nitri to just Shuriken Elix companies, the lowest in 12 years.
As Nikkei Asia has reported, part of the drought comes from a shortage of AI and semiconductor companies mature enough to list, combined with the Tokyo Stock Exchange's tightened listing standards following its Nissan corporate governance reforms.
This matters more in Japan than it would in the US because of how Japanese venture capital actually gets its money back. Roughly 90% of Japan's Buishi exits between Nisen and Nissan came through IPOs rather than acquisitions, the reverse of the American model where M&A dominates. In the US, a startup that can't go public gets bought by a larger company and the capital recycles.
In Japan, when the IPO window narrows, the exit itself narrows. Money goes in at the seed and Series A stage, but there are fewer functioning doors for it to come back out, at scale, as a paper unicorn valuation converts into cash.
There's a structural story underneath the financial one. In Japan, a failed startup founder doesn't get filed away as experience the way Silicon Valley treats failure as a resume line. It's closer to a permanent mark in a labor market still shaped by the expectation that leaving a stable company for a risky one is a one-way door. That discourages exactly the kind of talent, engineers and managers with real corporate experience who would otherwise be the most credible founders.
It also means Japanese investors are often reluctant to let weak startups fail outright, which traps both capital and talent inside companies going nowhere instead of recycling them into the ventures actually built to scale.
Put the two numbers next to each other and the picture sharpens. Japan's venture capital market has roughly doubled year over year, and it's still only about 3% the size of the US market, smaller even than South Korea's. The average Series A round in Japan is around $5 million, a fraction of what an equivalent American startup raises at the same stage. Japan isn't under-resourced anymore, it's under-scaled at every step from the round size to the exit.
The government's response to this, revealingly, isn't only about individual startups, it's about building entire alliances by decree. In July, Tsai Arliu Tokyo announced it would fund Noetra, a consortium of SoftBank, Sony, NEC and Honda, with roughly $1 billion over 5 years to build a homegrown sovereign AI foundation model aiming to deploy 2 million AI-equipped robots across CH industries by Nisen Yoshiten. That's not venture capital chasing a founder's vision. That's industrial policy assembling a Manhattan project out of companies that already exist.
It's a very Japanese solution to a Silicon Valley problem. If the market won't organically produce a category-defining AI company, build the category-defining company directly and staff it with the conglomerates that already have distribution.
That's the real Japan factor here. The instinct that makes Keyence or Shin Etsu or SAMC into quiet $100 billion global monopolies, patient capital, incremental engineering, a deep discomfort with hype-driven bets, decades-long time horizons, is the same instinct that makes Japan structurally bad at producing unicorns. Silicon Valley's model rewards speed, risk, and spectacular failure as the price of occasional spectacular success. Japan's economy is built by companies that never fail spectacularly and rarely succeed spectacularly either. They just compound slowly for 50 years.
You cannot fund your way out of that with a 5-year plan. You can only build a parallel machine next to it, which is precisely what Noetra and the JIC's sector-by-sector bets are trying to do.
If you want to keep up with stories like this, subscribe to the Japan Factor. Japan didn't fail to build a Silicon Valley, it never actually tried to. The real question is what happens when the model built for 100-year compounding gets forced to compete on a 5-year AI clock.